So let's look at some of the other advanced decision metrics that are built into this feasibility application, and you'll be able to understand and get your head around what these are and what do they mean for your feasibility for your project, and what sort of decisions you can make by finding out what they are. So they're all available in the summary section. So there's a bank summary and there's a developer summary. And as we go along in this course, I'll explain you the difference between the two. However, they are exactly the same for the Australian market as well as the international market. So let's look at what these advanced decision metrics are. So we're going to talk about equity multiple, interest coverage ratio, cash flow coverage ratio, cost of debt, debt to value, and financial leverage. So let's look at this section here. So we've got up top, we've got our development profit. So this is the profit for the project. In this column, we basically get a profit by per unit. And if it's international version, it won't have XGST over here. So international version will just say per unit right here. So that is the difference in here. And this is dollar per meter square, which basically means how much money we made as a dollar per meter square or dollar per square feet based on the total built area. So let's go back in here, and we've got some details to go through. Development margin on cost, that tells you the total development margin on cost. This is number one thing that we look at, what the project actually makes on cost. This is development margin on revenue. We've got land versus GRV, which is like a benchmark of what the land was with respect to the total GRV of the project. And we've got construction versus GRV as well, and we want to make sure that it stays between the 50% mark, or below 40% is even better. And this is the residual value of land, or the target margin. I discuss more details about the residual value of land in the validation feasibility course. So I would assume that you already know what that is. And then you've got, based on the target margin, you've got NPV, and then you've got return on equity and equity multiple. So your return on equity, as we discussed earlier, it's basically the money that you actually made on that. And the equity multiple is another way of expressing the same thing, which basically tells me that if you were to put in $100, you can multiply that by 1.44, and that's the money you'll make on your money. So that's what the equity multiple is, an expression of return on equity. Interest coverage ratio is a measure of project's ability to meet its interest payments. It is a measure of the number of times a project could make the interest payments on its debt with its EBIT, which is earning before interest and tax. It determines how easily a project can pay interest expenses on outstanding debt. Lower ICR, which is the interest coverage ratio. The lower the interest coverage ratio, the higher the project's debt burden, and the greater the possibility of bankruptcy or default. So let's go back and have a look at it again. So we had an interest coverage ratio of 6.37. So the lower, this is a good interest coverage. That means the project can actually cover the whatever interest that it needs to pay 6.37 times of whatever it has paid for this project. So it's more than it can well and truly cover in case of a debt scenario. And this is not something shown in a lot of feasibilities, but this is what the banks would look at. And that's the reason you must understand that when a bank says, sorry, I can't lend to you, it's because their interest coverage ratio is based on their calculations coming out lower. So if it comes out lower, that means it's a higher risk in the project. A lower ICR means less earnings are available to meet interest payments, and that the project is more vulnerable to increases in interest rates. When a project's interest coverage ratio is only 1.5 or lower, its ability to meet its interest expenses may be questionable. And an interest coverage ratio below 1.0 indicates the project has difficulty generating the cash necessary to pay its interest obligations. That is, interest payments are exceeding the earnings before interest and taxes. A higher ICR is a good thing, indicates a better financial health, as it means that the project is capable to meet its interest obligations from operating earnings. Cash flow coverage ratio, which is CCR, it's an indicator of the ability of a project to pay interest and principal amounts when they become due. So that means the cash flow, whenever it's actually going to fall due, it's an ability of the project that it can actually pay these things. This ratio tells the number of times the financial obligation of a company are covered by its earnings. So what it is telling me that whatever financial obligations that I have for this project, I can cover it twice in this scenario. Cash flow coverage ratio, if CCR is equal to or greater than 1, it means that the project is in good financial health and it can meet its financial obligations through the cash generated by development activities. And if it's less than 1, it is an indicator of high risk of bankruptcy default of the project. CCR indicates project's liquidity, and this ratio is often used by the banks to decide whether to lend or refinance any loan for this project. So cost of debt and equity. Cost of debt and equity is equal to total interest cost divided by total debt times 100, and cost of equity is equal to total interest cost on developers equity divided by total developers equity times 100. So if we go back into our sheet and we look at cash flow coverage ratio is 2.10. We've got developers total equity that the developer had to actually put in is that much. Then we've got cost of debt, which is 9.07, debt to value ratio 47.6, and the financial leverage, that means how much could I leverage from my own money in order to do this project. So that's what this talks about. Now, weighted average cost of capital we discussed in the previous video. It was basically the same as the hurdle rate. And it's a term used mostly in institutional investors, where what is the opportunity cost of your money. And if you were to calculate this based on what did you borrow, how much did you borrow this for, what was the cost of your equity, and what was the cost of the total debt, you'll be able to figure out what your weighted average cost of capital would be. So if I was to, that means that my hurdle rate here is 10%, which is way more than the weighted average cost of capital, which is only 8.1%. And that means it's actually a good thing, because I'm actually benchmarking it at a higher hurdle rate than the weighted average cost of capital. So that's what this actually tells you. So before we actually go, let's quickly recap some of these ratios that I've got here. So debt to equity ratio is basically the proportion of equity and debt used to finance the project. Debt to value ratio is the proportion of debt versus the realization value of the project. And the financial leverage is the extent to which the project is using borrowed money. Same as your LVR, or the true LVR, or the LTV, which is the loan to value cost. So financial leverage ratio of a project is higher than 2 to 1. It indicates financial weakness. So let's look at what we got. So financial leverage is higher than 2 to 1. So that means that we've got 1.159. It indicates financial weakness, but it's not. So that means we borrowed too much kind of thing. So it has to be between that level. Okay, so in the next video, we're going to start diving into how to use the financial feasibility application. And this was the end of all the theory that I had to discuss and link back to the financial feasibility application, so you have a better understanding of what these numbers mean and what they are actually doing here.